Good morning, everyone. Happy June 2nd, if you can believe it's June already. My name is Michael Crescione, and I'm a partner and co-practice leader of Citrin Cooperman's Healthcare Group. Thank you all for joining us today. The focus of today's webinar is what to do now, since you have received various amounts of funding from the government and states, and what you can expect to occur over time. For skilled nursing providers, you received targeted funding last week from the CARES Act Provider Relief Fund. You should feel good and some relief over the receipt of these funds. As accountants always say, cash is king. And I'll put a strong pause and emphasis to this, remember documentation of how you are using these funds is critical. Please remember that. Pam and Karen, two presenters, will go into more detail about this during their presentations. A few housekeeping items. We'll have approximately 10 minutes at the end of the presentation for Q&A. Feel free to submit your questions. We'll address as many of them as we can. If time does not permit, we will provide responses in writing along with the slides. We have a great lineup of presenters today that have been extremely busy researching everything COVID-19 impacting post-acute organizations. Each provider will provide a brief introduction of themselves. So now, Pamela Sowell will kick off today's discussion. Take it away, Pam.
Hello, everyone. I've been in the healthcare practice for many, many years, and these are certainly some of the most exciting times that I've ever lived through. I'm sure many of you would feel the same way. Part of what we're going to talk about this morning is to think about the fact that you've received funding. And really, now that you have the funding, now what is going to happen to you? So for a minute, you can sit and celebrate, breathe, relax a little bit, get back to work. Yes, get back to work. You heard me right, because as soon as you've congratulated yourself for getting some funding, now you want to think about how you are going to address the funding and what some of the needs are surrounding the receipt of the funds and any reporting requirements. So really, in our goals for looking at our funding sources, we want to optimize the funding, we want to avoid compliance pitfalls, and then avoid aggravation, because as we all know, aggravation means a time drain, and none of us can afford any time drains in these busy, busy times. So as we think about our funding, there are three key areas that we want to focus on. One is monitoring. So we want to understand the terms and conditions of the funding sources, and also be very careful to keep up to date with revisions, the evolving guidance, and maybe some new funding opportunities that come along so that you have that awareness. It's really important to understand and know the websites for the various funding, so that we can see what's happening and check in periodically to see if there have been any new releases of information. In the compliance arena, we want to establish some written procedures and protocols to track and document the funds and whatever we're going to be asked to provide in documentation and reporting down the line. You might want to be thinking about a cost accounting methodology to identify the direct and indirect expenses that relate to each of these funding sources. And once you've identified those, you want to educate your staff who are involved in compiling this information to make sure they're educated about the important elements. And lastly, in compliance areas, you'll want to look at how the reporting is tracking. Is it meeting all the benchmarks and the attributes that you had identified? And are you really capturing everything that you need to capture? So self-auditing will be really important. And at the end of the day, tracking and reporting means that you've identified each funding source, the date, the amount, the conditions, and that you understand what is needed to optimize each funding source. So you really want to identify those main questions we always ask: who, what, when, where, how, and why. And when we answer each of those questions relative to funding sources, we'll be able to design our processes to capture the appropriate information. Turning now to the first funding source. Turning now to the first source that we'll talk about, the Provider Relief Fund. So in the Provider Relief Fund, understand that this money came to us in tranches, and there were various terms and conditions that are associated with each separate money allocation that has come about. There are some important ones that a provider can't be excluded from federal health care program or terminated from Medicare. It's to be used only for COVID to reimburse healthcare related expenses or lost revenues attributable to COVID. And it can't reimburse lost revenues or expenses that another program is already funding. You have to certify that you're not seeking to collect out-of-pocket expenses from COVID patients. And there are certain key areas that you can't use these funds for. And some of them, they're enumerated in each of the terms and conditions, relate to gun control, lobbying, legislation of controlled substances, et cetera. So you've got to be working in the COVID area. It's certainly been clear from the funding sources that as you're providing care for your patients, whether they have COVID, are asymptomatic, they're all potentially COVID patients. And so all the service that you are providing are eligible under the Provider Relief Fund. So when we think about monitoring these funds, we have to review the terms and conditions. Now, the government allocated these first tranches of money without determining whether a provider needed them or not. So your first real decision is to decide whether you want to accept the funds or not. If you want to accept the funds, then you have to ensure that all the terms and conditions are met. And there is a fair warning here that, and it is brought into the literature, that the government has a federal False Claims Act, which will be implemented with the provider relief funds if necessary. So if a provider retains the funds without justification, they could be exposed to the False Claims Act, and the penalties for that would be a return of the money at threefold the amount. So that's a pretty sizable hurt. So please, in all of your considerations with monitoring, note the documentation, and then you may want to seek advice of financial or legal counsel just to make sure you're on the right path with this. From a compliance perspective, you've got to complete the attestation form and submit it timely. Now that's recently been extended to July 9th. You want to consider whether you should place the funds in a separate cash account so you can easily monitor the uses as you relieve that account. Not required, but a good idea. Carefully tracking and documenting the expenditures is important. And you want to make sure that you keep this documentation for at least 3 years after the program concludes, because the desire by the government for a potential audit has not been fully expressed yet. So we don't really know what the future HHS guidance will be. So right now, without that guidance, you would err on the side of over-documenting any expenses or lost revenues that you're attributing to this program. Certainly compliance with the Provider Relief Fund should fall right in line with all the other compliance attributes that all providers currently undertake. You've got some pretty significant compliance programs. So take into account now the things that you're setting up and designing for procedures with provider relief and incorporate that into your compliance. Now in the tracking and reporting, the first reporting requirement, even though it hasn't been fully specified yet, will occur for the calendar quarter ending June 30th, and it's due July 10th. That is one quick turnaround. What will you need to report? Currently, we know that you'll need to report the total amount of funds received. Also, what have you expended or obligated for the funds that you've received? And then you might want to detail a list of each project or activity that relates to those funds. If you've created new jobs, the number of new jobs created would also be helpful. And so there is a lot of documentation that will be required here. And either the Secretary of HHS or the Inspector General or the Pandemic Response Accountability Committee will be those requesting. So if we back up one slide, one previous slide, you'll see the website at the bottom of this page on the Provider Relief Fund. That's the site that you want to check every time to make sure that you're up to speed with those requirements. Moving on now to the Medicare Accelerated Payments Program. This was a program that was to ensure cash flow to providers and suppliers that are impacted by COVID. anticipating that there would be a disruption in the claims submission and or claims processing activities. So either claims submission from the provider side or claims processing from the payor side. So these monies could be requested, and these were ones that a provider had to take an active step to request and receive. That funding pretty much wound up at the end of April. The term of these funds is for the duration of the public health emergency. So in order to participate and be eligible to ask for an advance payment, a provider had to be eligible. So you had to have billed Medicare for claims within 180 days of the request. You must not be in bankruptcy, under active medical review or program integrity investigation, and you must not have outstanding delinquent Medicare overpayments. So those were the requirements. Once you submitted your application to your MAC, you could request up to 100% of the Medicare payment for the 3-month period. So now in the repayment side, what's going to happen? So again, this is a cash flow mechanism. So if you applied for and received these monies, you got a cash infusion and it was up to 3 months of your estimated Medicare claims. Now, 120 days after you received that infusion, there will be an automatic recoupment process that Medicare will use, and they will use it and it will be visible on your remittance advice. So during this time period, since you received the monies, I imagine you've been submitting your claims to Medicare and they're being settled and paid. That's wonderful. Come 120 days out, so now we're talking sometime in August, those remittance advices, you will see that the government will first look at a processed claim and say, well, for this provider, we advanced X amount of dollars under the Medicare Accelerated Payments Program. We're going to recoup it. And so it might mean that on your vendor remittances starting in late August, you won't have a net check being transmitted to you or a net settlement to you because it's being used to recoup the monies. Now this recoupment period will go on for a year's time from the time you receive the monies. So in an example, if you received an advance payment and just a nice round number of $100,000 in April, in August, when you are filing some of your claims at that point in time, if you have claims that are settled and equate to $80,000, you won't receive any money transfers for that because the $80,000 will be entirely accorded to the Medicare advance of $100,000. So you'll have a net $20,000 that will carry forward to your next series of claims until that's entirely recouped. So a cash flow mechanism that was beneficial for many providers. Moving on now to the next program, which is a Rhode Island specific program. It was a workforce stabilization fund allocation from the state of Rhode Island, and many other states may have contemplated a similar type of fund. This one was designed to support frontline workers who were earning wages at the lower end of the spectrum, under $20 an hour. And it meant frontline workers who were working with patients in the provider location. So if you had remote workers who were administrative or other, they wouldn't be eligible for participation in this program. The funding was designed to be an employer obligation, and it starts out as a forgivable loan program. So the employee is not on the hook for anything. It's the employer, the provider. It's a non-interest-bearing loan. And the monies were applied for based on the head count of personnel that you had that were being compensated at under $20 an hour and worked 15 or more hours per week. So the way the program worked was you submitted an application to the state of Rhode Island. Based on that application, the monies were funded to you. Now, the term of this runs for a 4-week payroll period from May 4th through June 1st. That's a Monday to Monday pay week period. Certainly, if your payroll doesn't coincide with those days, you would use your pay periods that fit into that 4-week period. So if your payroll starts on a Saturday, you would go Saturday to Saturday, not the Monday to Monday. The whole concept behind this particular program is to put money into the pockets of lower paid workers who are actively working on a provider site. So what that means is the distribution of the funds would be paid to your staff who were eligible based on every payroll week that you normally pay. So if you're a weekly payroll provider, every week you would look to those lower paid folks, what number of hours per week in that payroll period did they work, and then they would be afforded one of three different dollar amounts depending on how many hours that week they worked. And it ranged from $100 for somebody working 15 to 21 hours a week to $200 for somebody working 30 or more hours a week. The whole design of this program is meant to put the cash in the employees' pockets timely each payroll distribution. What that means is you cannot hang on to the money yourself as a provider and give it in a lump sum payment at the end of the 4-week period. It's meant to be paid every week and only for worked hours. So if you applied for somebody that was a 40-hour person earning under $20 an hour, and they happen to take a week's vacation during this 4-week period, you're not eligible to request that or to pay that to the employee because it's not worked hours. If you had folks that you requested money for and you did not incur the time for one reason or another, they didn't work the hours, et cetera, then those funds would need to be returned to the state. And conversely, if you underestimated what your needs were for those lower paid workers, you could ask for an incremental request. So here in the tracking and reporting, your payroll records are going to be key. And the payroll records will be key not only in demonstrating the hourly rate, but also the number of hours worked for these key employees. Now, the state may be asking, though they haven't specifically asked yet, they may ask for payroll records that go back to the February time period, well before the pandemic came into being here in Rhode Island. And they may ask for that payroll information to make sure they've established a benchmark that these were in fact lower paid workers under $20 an hour. Then going forward, they're going to be looking probably for payroll records during this 4-week time period. Now, one of the big things that we want to warn you about and caution you about is the characterization of these funds as a bonus. Now, certainly the CARES Act prohibits any spending of any of these fundings for a bonus. So if you're calling it a bonus in your conversation, that's fine. But if your payroll records for these weekly payments or biweekly payments are labeled as a bonus, you may want to get that changed within your payroll system. We all know we have a boatload of different payroll codes that we use, regular, overtime, vacation, sick, et cetera. So you'll be able to work with the payroll reporting itself to label it, but we caution you not to use the word bonus. Certainly, another caution, you have to comply with all the public health recommendations. And if you have folks that are participating in your pension plans, you may want to look to see if these fundings are going to be called compensation, and then whatever the plan requirements are for participation in the pension plan, these monies might be considered part of those normal wages that would be subject to pension plan participation. Certainly, there's a failure to comply penalty with all of this. And so the failure to comply is that you would have to pay either in whole or in part the entirety of the monies before September 30th. So again, this is a great bonus for the folks that are on the low end of the pay spectrum and are really working hard, as we all are, to provide the services. So with that, those were the 3 key program funding mechanisms I wanted to talk to you about. And now we'll be turning this over to Kieran, who will talk to you about how you're going to manage some of these provider relief funds.
Thank you, Pam, and good morning, everyone. My name is Kieran Higgins with Citrin Cooperman. I am in our business process outsourcing practice and the healthcare practice. I specialize in decision support, financial operations, and special projects in the outsourcing function. Healthcare specifically is my passion. I've spent a number of years in various senior level positions, financial senior level positions in both the post-acute space and then the inpatient hospital ambulatory space. With that being said, thanks for joining today, and we're going to get right into how you should be tracking and managing the provider relief funding and distributions. So as many of you know, there was a lack of guidance when the funds did hit, and I'm sure, just like everyone else across the country, you're scattering to figure out exactly what needs to be tracked, who, how, where, and why. And I know, as Michael mentioned at the opening, as accountants, as a public accounting firm, we want you to be tracking everything as much as possible. So the first thing you can do is, and beginning in July, so set to begin in July 2020, you're going to need to report on the lion's share of most of these funds. So you need to be carefully tracking the receipts and understanding your eligibility and uses. With that being said, you also need to establish internal controls. So internal controls that, with the process of assuring your organization's objectives in operational effectiveness, efficiency, with reliable financial reporting and compliance with laws and regulations and policies. Those laws, regulations, and policies are the typical Code of Federal Regulations. It's 75.302 for those of you who may not have experience with it. That guideline follows a lot of the other value-based care components you may remember, CPC Plus or the bundles or all the other value-based collaborations across the country. That is the recommended way of tracking it, and it's you must, as I mentioned before, have written procedures for determining the reasonableness, allowability, and allocability of costs in accordance with these federal cost principles and terms and conditions of the awards. You need to maintain accounting records that are supported by the source documentation, and make sure your systems are accurate and completely disclose the results of the financial, the financial use for each by project and program. So CMS and OIG can review these selected grantees, you as selected grantees who receive HHS funds from multiple sources to determine whether you are allocating or claiming costs in accordance with these federal regulations. So they're going to draw a line in the sand to take a look at your cost accounting principles, and with many of you experiencing SBA and PPP, there's little or no guidance, or the fluidity of the guidance is changing almost overnight. So we need to be as diligent as possible in tracking, and I'm going to get into that a little bit more in the next couple slides. So in front is a cost accounting methodology that we've developed here at Citrin Cooperman in collaboration with some other folks and with input from our clients. Essentially, as a recipient of any of these funds, you're certifying that payment will be used for the prevention, the preparation, and or response for coronavirus, and that the monies you receive shall reimburse for only the healthcare related expenses or lost revenues that are attributable to coronavirus. And I know that's a loose term, and we'll get into a little bit more. When you do take these funds and attest to them, you're certifying that you will not use the funds for other areas where you may have gotten additional funding. For instance, PPP. If you've gotten PPP that can cover payroll costs during this time, you're not going to use the provider relief fund to cover those same things. And I know right now it may be hairy to see what's been used where. So that's why, as accountants, we recommend you being diligent on the tracking of that. So what does prepare, respond to prevent mean? So prepare is defined as the continuous cycle of planning, organization, training, equipping, exercising, evaluating, and taking corrective action. Respond includes action taken to save lives and prevent further property damage in an emergency situation and or damage to patients or residents. Response is putting your preparedness plan into action. Prevent includes activities that prevent an emergency, reduce the chance of additional emergency happening, or reduce the damaging effects of unavoidable emergencies. Many of you went into COVID-19 with succinct plans, I imagine, and I'm sure you're doing your best. And you may not even realize you have already bucketed the function your organization is undertaken into these three categories. Us as in a public accounting firm is that, here to help advise on how you cost account for those different items. I have some categories below, and before I advance to the next slide, I'll just run through this as a blank slate template. When you're looking at tangible direct and indirect costs, these may be the ones that are easier for you to think through and cost account for, and sort of what you're used to. Now, some of the intangible costs, they're the ones that are going to be very hard to measure. They're things you might not take into consideration that do have an impact on either the quality of the care and your reimbursement or things like that. Foregone revenues, again, that's a little easier to track as tangible direct, but there may be things you don't think of in there that it may warrant a little bit of investigation. So advancing to the next slide, laying out many examples, and these are industry examples, client examples, best practices across the country that we're seeing as a firm, as a public accounting firm, to which the funds are being used for in the right mechanism, and a lot of this is going back and forth with the governing bodies, lobbyists, and such to maintain the fact that the money is using. So as I said before, the tangible direct and indirect costs, many of these items may not come to a shock to you, and I'm not going to go through them verbatim. You can see on the screen, additional staffing, agency labor, things like that, leasing obligations, conversion spaces, capital expenditures you may have made. There may be wasted resources in the categories, things that go bad and that, in a normal course of business that they wouldn't have happened. Now, the intangible costs are something I want to pay a little bit more attention to in addition to the foregone revenues. These are things that you might not think of as expenditures in the past, but you need to find a way to cost account for them and think through the parameters here. And quality scores, there's not a ton of guidance out yet on the impact of quality scores utilization. I know we are in response mode, so that is much harder to think about. But many of especially if you're very inundated and high utilization, that it could impact your scores for years to come. We don't have clarity on that yet per se, but it's something as leaders should be thinking of just in case. Turnover and recruitment costs, many of you have probably experienced that, and the various unemployment initiatives that have been rolling out. It may be hard to find folks to come back to work, and you have staffing issues and overtime issues. You want to be able to measure and track that. Foregone revenues, this is the biggie. You can look at this a few different ways. You can look at your lost census days, or your lost volumes in general, or your acuity payer mix. So take a look at your budget, reforecast, and do a variance and trending analysis. Something you might not have thought of in this case is, okay, but my volumes are better. I'm doing better than I did last year. Okay, well, do you have any new facilities? Do you have any new service lines? Do you have a new population base that you weren't servicing in the past? You need to take a look at this in aggregate, same store compared to last year, so you are comparing apples to apples. That is something that many clients have asked me. Hey Kieran, I'm doing better than I thought. And when I'm looking at the detailed reports, I can see that some locations are suffering and others aren't. So take a good look at that. I think that is the one opportune area that you'll be able to pick up the uptick of lost revenues, and because along with tracking and there's going to come a time where you need to report these. You need to report these to the federal government, whether it's EIDL, FEMA, or the various other initiatives that are going to be out there. So moving to the next slide. The cost accounting methodology. And I do want to give a heads up, for those of you that have received funds, there's no later than 10 days after the end of each calendar quarter, recipients that receive more than 150K total in funds under either the CARES Act, the Coronavirus Preparation Response Appropriations Act, and the Families First Coronavirus Response Act, or any other act making appropriations for coronavirus, you need to submit the reporting. And that reporting must contain, and this isn't just one, this is a reporting of all of them. And you need to report the amount of funds received from HHS, the amount of funds received that were expended or obligated for each project or activity you're tracking, and a detailed list of all projects or activities for which large covered funds were expended, obligated, including the name of the project, the description, and the estimated number of jobs created or retained by the project where applicable. The detailed information of the subgrants or subawards, must be included. And for those of you who may have not have navigated HHS or CMS portals, it could be, a tall task to get in there and provide the detail they're looking for. And I know we all have a certain bandwidth, and there's other more important items to get to, but these are very important to attest because, as I said, there is going to come a time where they draw a line in the sand and take a look at the accountability of these funds. And there is still not a ton of guidance on how they're going to say claw back the funds per se, but I could imagine that they will take foregone future revenues against the items that you don't attest for or provide clarity. I've been through several CMS or OIG audits. Some are the easier ones are when you come prepared with a project budget, and with the GL detail from your accounting or EMR system to proving the funds and providing, like any audit, providing the backup or assurance information that these folks are looking for in a complete and concatenated fashion. So in front of you is my additional approach, that I've sort of talked about and used in the past for various other value-based collaborations and gearing up clients for in preparation for reporting. And we went through these on the previous slides, but whether you're building a specialized project budget or taking care of tracking with either using your inside internal EMR budgeting tools or outside in Excel. There is no right way to do it. You need to do what's feasible for you. I will say, I'm going to put this out there, the second tranche of more localized provider relief HHS funds, tomorrow is the deadline to apply. And if you haven't applied already for those funds, so for those of you who maybe missed in the first tranche, please do so. Pam actually provided the links in previous slides. Take a look at that and make sure that you report out and can get whatever funds that you're qualified for. That being said, I'm going to hand it over to Jerry. And next slide.
Thank you, Kieran. I'm Jerry Adaluca, a tax director with Citrin Cooperman for the last 10 years, and I'll be providing an overview of certain tax implications of many of the COVID-19 relief provisions previously discussed, and maybe a couple other ones that haven't been discussed. So the first one that I wanted to get into is perhaps the one that everybody is most familiar with, the Paycheck Protection Program. Now, while everybody has become familiar with the rules and requirements of the PPP, and certainly they've changed quite a bit since they first come out, I wanted to focus on a couple of important considerations from a tax perspective. The PPP was promoted on the premise that all or a portion of the loan would be forgiven. So what does loan forgiveness exactly mean for tax purposes? Well, forgiven income is classified as tax-exempt income, which is favorable from a tax standpoint. However, the expenses that are associated with the tax-exempt income become non-deductible. Therefore, the result is taxable income. So one of the considerations, relating to the PPP loan is exactly what are the lenders going to permit for distributions. Distributions are often computed based on financial statement income and other loan covenants. And will these additional distributions be permitted, will the additional income, be permitted for distributions? These distributions may result in capital gain to the owners because they may be in excess of tax basis. And presently, as we sit here today, it's unknown what position various lenders will take on this issue of calculating distributions. It's probably recommended at this point that you reach out to your lender and try to get some clarification on this point prior to taking any distributions on available cash. And then a consideration pertaining to not-for-profit entities will be the classification of this tax-exempt income on the Form 990. And again, the IRS has not yet ruled on this issue. The thought is, could it possibly be included in public support, maybe as a grant equivalent, which would certainly favorably influence the public support percentage as calculated on Schedule A. So that's a couple of issues relating to what's been going on with PPP. However, late last week, the House passed what's known as the PPP Flexibility Act, and the Senate is expected to take up the act this week. So things obviously are very fluid at this point. They've heard some of the common complaints about the program, and amongst the highlighted changes or potential changes are an extension of the overall program from 8 weeks to 24 weeks, an extension of the utilization period of the loan funds from 8 to 24 weeks, an extension of the rehiring deadline from June 30th to December 31st. One of the larger changes or more significant changes could be the decrease in the minimum required amount of eligible payroll costs from 75% down to 60%, with a corresponding increase in the limitation on eligible non-payroll costs from 25% to 40%. And also an extension of loan repayment terms has been proposed from 2 to 5 years. And another one is the potential full access to the payroll tax deferment program for businesses that take PPP loans. And as we'll see a little later on, presently there is a limited access to the payroll tax deferral program for these businesses. Next slide, please. The Economic Injury Disaster Grant. It's separate and distinct from the Economic Injury Disaster Loan Program. It's treated as a grant, therefore there's no repayment required. The grant will reduce the amount of PPP loans which can be potentially forgiven. And we should note that grants create taxable income. However, grants do not contain a restriction on the deduction of the expenses associated with the grant, as opposed to the tax-exempt income concept associated with the PPP loan. Next slide, please. The Rhode Island Workforce Stabilization Loan Program has many of the same characteristics as the PPP loans. And from a tax standpoint, it will be treated very similar to the PPP loans. If the income is forgiven, it'll be classified as tax-exempt income with a corresponding disallowance of those expenses associated with the utilization of the tax-exempt income. And while this is a Rhode Island program, Rhode Island has rolling conformity with the tax code. So unless Rhode Island decouples from a provision, the provision is automatically applicable to Rhode Island. So under the IRS code, tax-exempt income produces non-deductible expenses that are associated with that income. And again, the same potential issues as the PPP with respect to distribution calculations, as well as Form 990 reporting, or are associated with the Rhode Island Workforce Stabilization Loan Program. Next slide, please. Provider Relief Fund. A significant aspect of the Provider Relief Fund is the requirement to submit tax returns. So if you haven't submitted a 2018 tax return as of the time of submitting your application, unless your 19 return was done, then you are ineligible to apply for such relief. However, it doesn't preclude a late filing being submitted. So if you haven't submitted your prior year tax returns, let's say it's 2018, if the year 2019 is on extension, it's not too late now to file the 2018 return and still become eligible to participate in the next round of funding. And as we talk about there, the Provider Relief Fund is treated as a grant, and as we previously discussed, a grant is considered taxable income, and there's no restriction on the deduction of the expenses associated with the grant. And I think by now we can start to see a common theme developing among these relief provisions that we have discussed so far, and it's gonna continue to be pervasive through the next group of relief provisions as well. And the overall theme developing is that taxable income is resulting from these provisions, whether it be from grant income or the disallowance of deductions associated with forgiven income, or as we're going to see next, reimbursements from the government against previously deductible expenses. So before we overview the next three incentives, which all provide the employers relief from their FICA matching contributions, I want to point out that we have a summary of these provisions on slide 21, comparing the various benefits and rules associated with each incentive. So we're just going to more or less do a tax overview of each one, but the summary is a nice comparison where you can just go to one page and find each and every one of these provisions. Next slide, please. So the refundable tax credits for paid and sick family leave actually are two separate credits, and applicable to employers with less than 500 employees. And as we noted there, employers with less than 50 employees may opt out. But this concept of employers with 500 employees has received some airplay, in particular with respect to related companies. And as you may imagine, there are some distinct rules that govern how related companies treat their employees. So in the context of the 500 employee rule, the threshold to clear is obviously, are the related companies going to be treated as one employer or as separate employers? And there are two laws that govern these. The paid sick leave credit, the determination is made under the Fair Labor Standards Act of 1938, while the paid family leave credit determination is made under the FMLA, Family Medical Leave Act of 1993. However, both of these determinations lead back to this central concept of the integrated employer test, which considers certain factors in determining if the number of employees of a related company should be aggregated or if in fact treated separately. And no one factor is decisive in and of its own, but the factors to consider are common ownership, is that 50% or more similar ownership between related companies, common management, the interrelationship of operations between the related companies, as well as the centralized control of labor relations. Next slide, please. The employee retention credit. And as you can see there, it's not available if the PPP loan has been received. There has been no mention in the PPP Flexibility Act as it presently stands of eliminating this restriction. And There are two tests associated with the employee retention credit, as you can see there. But with the employee retention credit, the key factor is that the employee threshold is only 100 employees. And it's important in the context of whether your full-time average number of employees during 2019 is less than 100 or greater than 100. So if it's less than 100, wages paid to all employees, regardless of whether or not they're working, are considered for purposes of the credit computation. However, if your average number of full-time employees during 2019 is greater than 100, the wages only include payments to employees who are not working due to either test 1 or test 2, as documented on the slide. Next slide, please. The employer payroll tax deferral. Presently, the CARES Act permits the employer payroll tax deferral with a PPP loan only until such time as the loan is determined by the lender to be, or all or a portion of the loan is determined by the lender to be forgiven. So there is a limited period presently where somebody with a PPP loan could also take advantage of this particular provision. The PPP Flexibility Act would allow this through the end of the year with a forgiven PPP loan. So that could be a potentially significant benefit. As you can see here, this payment is deferred interest free with, one half due December 31st, 2021, and the other half 2022, which brings about an interesting consideration from a tax standpoint that once again, the IRS has not yet provided any guidance on. And the consideration is to whether or not these payroll taxes, as accrued during 2020, will be deductible on an accrual basis on your 2020 tax return, or whether or not they'll be required to be treated on a cash basis. When half is paid in December of 2021, that half would be deemed to be deductible in that year, and the other half when it's paid in December 31st of 2022. So we'll keep an eye out, certainly, for any guidance with respect to the timing of tax deductions relating to that. Next slide, please. This is, as I mentioned, the summary of these COVID-19 incentives relating to payroll. A couple items to note: under the employer payroll tax deferral column, the credit amount is $8,537 maximum per employee. And then, as we just discussed, the PPP Flexibility Act, if enacted by the Senate, signed by the President, would allow payroll tax deferrals with the PPP program. So the chart as it presently is constructed states that it's not allowed with the PPP program, but stay tuned for further action there. Next slide, please. So a lot of people may not be familiar with Section 139 payments, and I put it in here just for to bring it to your attention. It's with regard to federally declared disaster areas only, and this section of the code was enacted in response to the 9/11 attacks. So as a result of the pandemic, all 50 states plus the District of Columbia were approved as federally declared disaster areas. That makes these areas eligible for the Section 139 payments. And as you can see, the types of reimbursements here are not the traditional types of reimbursed costs that one often thinks of. So it's a more generous program to both the employer and to the employee. Next slide, please. I wanted to close out with some tax planning considerations. As I mentioned earlier, we've got this common theme pervading the various forms of legislation, in that additional taxable income is going to result from the various relief programs, thereby, making year-end tax planning even more relevant with everything that's going on. That's certainly something to consider well before the end of the year. Typically, year-end tax planning starts in October or November rather than waiting until the last minute in December. A consideration of the change of your overall method of reporting for tax purposes, from the accrual to the cash method. That may, if your receivables exceed your payables, that may help to offset additional taxable income during this year. And of course, that's subject to a couple of rules: the $26 million average gross receipts test, as well as the tax shelter status test. Net operating losses could become very valuable to individuals that own pass-through entities. There are net operating loss provisions that have been changed for C corporations as well, albeit we don't see as many of those these days. The net operating loss provisions have been changed to result in a removal of the 80% limitation on such losses generated in 2018 through 2020. And they've reinstated a generous carryback period of 5 years for net operating losses incurred in those years of 2018 through 2020. I wanted to take a minute and point out that right now, the fair market values of securities, possibly business interests and real estate, maybe at their lowest point in recent years, and consideration should be given to potentially gifting certain of those items if you have a mindset to take advantage of the lifetime exclusion, which is presently at $11.58 million. That could potentially be adjusted depending on the results of the election in November. Certainly that wouldn't change in 2020, so keep an eye on the election results, and that could make gifting flourish in the last couple of months of the year. An important consideration for individual taxpayers this year relates to their estimated tax payments, and you should consider utilization of the annualized income installment method, which breaks up your earnings during the year into segments, and obviously they're going to fluctuate significantly during the year, and your payments are permitted to fluctuate, with the corresponding changes in income. The last item that I had was Congress enacted the concept of qualified contributions in the CARES Act, and this is to public charities only, which excludes private foundations and donor-advised funds. And qualified contributions are required to be in cash, but when you make a qualified contribution, there's no AGI limitation. So you could, in theory, make a contribution to a public charity and completely offset your taxable income in 2020. That concludes the tax portion of the presentation. I'll send it back to Mike.
Thanks, Jerry, and thank you, Pam and Karen, for all the information that you've provided. As we've been trying to stress today, everybody is looking forward to moving in a new direction. Here at Citrin Cooperman, we are here for our clients and for everybody else to help them in this, what we call transition service. Because everybody's going to start looking at their own business a little differently now than they probably looked at it in the past. It's just going to be part of the new norm. I hate to use that word, but everybody's using it. So we just want to let you know that not only the individuals on the webinar today, but we do have many other individuals throughout the firm that are providing services in various areas, from crisis management to cash flow projections to financing to various transaction and advisory services. Just talking to many clients, you're going to be doing something, everybody's going to be doing something differently. From how nursing homes are probably going to have residents and families interact and how they come and go out of a building, to how home care and hospice providers are going to have their employees in and out of people's homes and what's going to happen. So there's going to be a lot of different protocols that are happening going forward. So please let us know and how we can help you. With that, we do have a few minutes for questions. One of the questions that came through was regarding documentation and examples for lost revenue. So Pam or Karen, could either one of you address that question for the audience?
Sure, I'll kick it off. Lost revenue, and the underlying theme of that question is the documentation. So if you haven't already heard from the presentation this morning, documentation is going to be key. And even though there may not be many specifics about how to document or what exactly to document, if you take a position and you document something and you have that evidence to show, should it ever be required by one of the payors as an audit service, then you have the ability to support the position that you've taken. Now, on the lost revenues, there are different ways to look at this. One is to look at your revenue per day before and then during the pandemic and compare the two in conjunction with looking at your volume. So if you are a provider that provides 24-hour care, you can look at occupancy. And you can say that, well, my revenue per day declined 10% and my occupancy also has declined for the comparative period by X number of percentage points. You can then value that with your average revenue per day and come up with a calculation of what you're currently losing. Everyone is seeing a difference in the mix of types of residents served and the types of payors and the contracts under which those routine payments are being paid. And so the calculation element could be simply 2 months preceding the pandemic and then the 2 months in the pandemic. What's the lost revenue associated with that? Kieran?
Thank you, Pam. And I think, you hit every category. The way I'm looking, and this segues to some of the services Michael was just talking about. I'm doing a lot of budgeting, cash forecasting, reforecasting, whether it's a 13-week cash flow, which represents, the next quarter, or 6 to 12 month and various scenario planning. As many of you know, the budget for this year is probably out the window, and I'm hoping some of you it's not, and I'm hoping that you're keeping up with the same volumes that you're expecting and warranting great results. But I know across the country that's not true for everyone, and me specifically, that's what I'm helping a lot of clients with, is taking a look at last year's budgets and volumes and using the metrics or parameters that Pam just mentioned, and then comparing that to this year's volumes. And as I mentioned in my section, think through some of the outliers of, say it's a new revenue stream or some new component that wasn't there last year. So maybe same store last year to this year's revenues are down significantly, but overall you're doing better than you were last year. That's okay, but we want to make sure you're tracking the loss of volumes that were atypical of what they were, in same store last year, and tracking that with a syndicated approach, whether it's a budget, either using your budgeting or planning tools, using your EMR, or other general ledger tools as well.
Thanks, Karen. Thanks, Pam. Jerry, can you answer the one of the questions that just came through? Maybe just give final closings on some of the takeaways that you want people to remember.
One of the questions that came in?
If you can just maybe give some final takeaways for what for-profit and not-for-profit.
Oh, sure.
That is.
I think we'll
Take
start
away
with
from all this.
Yeah, we'll start with the not-for-profit businesses. It's an economic issue right now where, charitable giving is likely decreased as a result of the pandemic. And certainly demands for support from charitable organizations has likely increased. And I think, one of the things to think about under the tax planning considerations is that the CARES Act has brought about this concept of qualified contributions to public charities, which are cash gifts. So I think from a not-for-profit perspective, they should consider marketing this benefit, possibly either when the economy approves or later in the year or even right now, because I think, certainly when we get to the end of the year, most folks are going to begin contemplating tax planning moves, and, charitable giving, could become an important focus of, many taxpayers. And, with respect to for-profit businesses, just one last time, I think that the certain forms of relief that we've covered in one way or another are all indicating that they will produce taxable income. So again, year-end tax planning is going to be as important as ever this year.
Thanks, Jerry. And with that, it's right at 11 o'clock. There are a few more questions that we will answer and get back to everybody specifically, but we want to thank everybody for joining us today. And as I mentioned before, these slides will be sent out in an email to everybody. And if there are additional questions, we will respond to those and answer those accordingly. So with that, on behalf of everybody today, we want to thank you for joining us. Be safe, be well, and enjoy a nice June day. Take care, everyone. Bye.